Whenever things get really uncertain in the world, whether it's a conflict erupting in the Middle East or major shifts in economic power, the world's biggest and most secretive investment funds start to quietly move trillions of dollars. They're called the smart money for a reason. They have access to information that you and I could only dream of, and they operate on a scale that's just hard to wrap your head around. So the real question is, where are they hiding their capital? Because when this much money moves, it creates a tidal wave, and you do not want to be caught on the wrong side of it.
And that's not some kind of exaggeration. We're talking about a wave of capital so big it can totally reshape entire markets, it can prop up some sectors for years while leaving others completely in the dust. Understanding which way that tide is flowing, well, that's one of the most powerful insights an investor can possibly have. But it's a story that almost never gets told.
So, to really get to the bottom of this, we're going to break it down into 6 key parts. We'll kick things off with the incredible scale of the money we're talking about, then we'll meet the players, understand their unique strategy, and then, and this is the crucial part, we'll learn how we can use their moves, not to just blindly copy them, but to become smarter, more risk-aware investors ourselves.
Okay, so geopolitical events don't just happen on the nightly news, right? They send these immediate shockwaves through the entire financial system. Things like wars and conflicts create what's called capital flight. It's this global rush away from assets that seem risky and into things that are seen as safe. And that leads to the $13 trillion question, where are the biggest players on the planet moving their money for safety and long-term stability?
And when I say biggest players, I really, really mean it. We're talking about a group of financial titans that, together, manage over $13 trillion in assets. Now, to put that number into perspective for you, that is more than the entire annual GDP of China. It's an almost unimaginable amount of capital, all controlled by a very, very small number of entities.
So who are these giants? They're called sovereign wealth funds, or SWFs for short. And even though they have this immense influence, they're pulling the strings behind some of the world's largest companies, a lot of people have never even heard of them.
To put it simply, a sovereign wealth fund is kind of like a nation's savings account, but on a colossal scale. It's this massive pool of money owned by a country. It usually comes from selling commodities, like all the oil and gas in Norway's case, or from huge foreign currency reserves. Their job isn't to make a quick buck. It's to invest this national wealth for the long-term benefit of their citizens, for generations to come.
Now, you might be thinking this is all happening in secret, behind closed doors, in these private backroom deals. But what's so fascinating is that their single biggest slice of the pie, according to research from State Street, is actually in publicly traded stocks, just like you can see here. They aren't just buying up buildings and infrastructure. They're some of the largest owners of the world's biggest companies.
And this right here just illustrates the scale perfectly. Norway's fund, which is one of the biggest in the world, holds over 1% of Apple. Just let that sink in for a second. A single fund owned by the people of Norway is one of the most important investors in one of the most valuable, most influential companies on the entire planet. Yeah, their decisions matter.
But here's what makes them so different. Unlike a hedge fund, their goals aren't just about getting the biggest returns. They have these core national functions they have to serve. Norway's fund is so massive that its returns cover a staggering 20% of their entire government budget. Saudi Arabia is using its fund to pay for these transformative giga projects to shift its economy away from oil. And China uses its network of funds to spread its diplomatic and economic influence around the globe, with strategic stuff like the Belt and Road initiatives.
Understanding these national goals is absolutely critical because it completely changes how they invest their money. They are not playing the same short-term game as everybody else, which brings us to their very unique playbook. Most of the chatter you hear about the market is just noise. It's short-term trading. It's reacting to every headline, every little price jump, all the market gossip. But these funds, they completely ignore that roller coaster you see on the left, and they focus entirely on the deep-rooted value on the right. They could not care less about today's stock price. They care about the fundamental value and the cash-generating power of a business over decades.
This little story perfectly captures their whole philosophy. One famous fund literally made its only stock ticker terminal uncomfortable to use. They put it on a table with no chair, just to actively discourage its analysts from getting sucked into the daily noise of the market. They wanted their team spending their time deep in annual reports and business filings, not staring at flashing red and green numbers on a screen. So here's the crucial point. They aren't just out there hunting for stocks that are going to pop 20% next year. No way. They need durable, high-quality assets that generate steady, predictable cash flow. And why is that? Because that cash is what pays for national pensions, what builds new infrastructure, and what funds government budgets. The cash is what matters, even if the price of the asset goes completely sideways for years.
Okay, so if these giants are out there making these huge, long-term moves based on some incredibly deep research, how can a regular investor possibly see what they're doing? Well, look, it's not easy, but it is possible to read their footprints, because a lot of them are left right out in plain sight.
The process basically mirrors what they do themselves. First, you look for what's called institutional sponsorship in a company's public filings, so like 13Fs in the US. Are these big funds buying in? Second, you got to do the work they do. You have to devour the annual reports to really understand the business inside and out. Third, you analyze the key valuation ratios, price to earnings, price to book, over long periods of time. And finally, you do the math to build your own model of what the business is truly worth, its intrinsic value, totally separate from its daily stock price.
And if that sounds like a ton of work, well, you're right, it is. The most famous investor who basically embodies this exact philosophy, Warren Buffett, reportedly reads around 500 pages of reports and filings every single day. That's the level of deep diligence it takes to invest with this kind of long-term conviction. And it's the exact same mindset that drives these multi-trillion-dollar funds.
Okay, so now we know who they are, how they think, and how to look for their tracks. So it might be really tempting to just find out what Norway's fund is buying and just copy them, right? Well, this is where we hit a brutal and potentially very, very expensive truth. This slide really lays out the fundamental difference in your goals versus theirs. A sovereign wealth fund is a legacy institution. It's built to last forever. They need stable cash flow to fund a nation for generations. Your goal, as an individual investor, is probably capital growth to fund your retirement in the next 10, 20, or maybe 30 years. These are not the same thing. In fact, sometimes they can be completely opposed to each other.
This timeline just makes the difference crystal clear. Their investment horizon isn't just long-term, it's multi-generational. We're talking 50 years, maybe even longer. They can afford to buy an asset that does absolutely nothing for a decade, as long as it's spitting out cash. Most of us, we just do not have that luxury.
And here is the real danger. An asset that pays a steady 4% dividend but doesn't go up in price for 10 years. For a sovereign wealth fund, that's a massive win. It's perfectly meeting their cash flow goal. But for you, that's a decade of dead money. Zero capital growth. Following them blindly could leave you bag-holding an underperforming asset that completely torpedoes your own financial future. So if we can't just copy them, then what's the point of all this? The point is to reframe how we see their activity. Instead of using it as a signal of what to buy, we can use it as an incredibly powerful tool for analyzing risk. And this brings us to the key takeaway, a concept I call the institutional floor.
The institutional floor is basically the price at which these giant, long-term, 500 pages a day investors have done all their homework and decided, okay, we're buying here. It suggests a price level where the smart money believes the asset is fairly priced, or maybe even cheap, based on its real long-term value. This can act as a really powerful psychological and financial support level for a stock's price, especially when things get volatile.
So let's be perfectly clear on how to use this concept. This is not a green light to just automatically buy a stock. It is a sophisticated tool for assessing your risk. If you're looking at a company and you see it's trading near a price where major SWFs have been buying up shares, it can give you some confidence that you're probably not wildly overpaying and that there is a bedrock of long-term patient support somewhere below you. It helps you understand your potential downside.
In these turbulent times, the world's financial giants are quietly placing their half-century bets. They aren't gambling, they're investing based on deep, fundamental value. And by understanding their playbook and learning to look for their footprints, we can't predict the future, but we can build a much, much smarter framework for navigating it. The only question left is, are you prepared to look where they're looking?